Talk the U.S. dollar. It has strengthened in recent weeks despite a barrage of bad U.S. data. The reason, well, the debt worries in Europe are even worse. So let's get to a fast money straight fight and bring in Peter Schiff, the CEO of Euro Pacific Capital. Peter, it's always good to see you. You've been bearish the dollar, and at this point, you still like a dollar short, but you're just sort of shifting the cross. Is that correct?
Well, I mean, I'm short the dollar against a number of things, but I think the reason that the dollar is strengthening is I think you have a lot of investors or traders that are starting to rethink their optimistic growth assessment. And you might think that that would be bearish for the dollar, but if it means that they're selling their gold or selling their commodities or selling their emerging market positions, they're buying back dollars. So I think the dollar is benefiting from that. And also, I think people take the Fed at its word. They think QE2 is going to go away in the summer. And that means that the weakening economy is going to be even weaker. So I think that's really what's going on. But I think if you really connect the dots, you understand that weak economic data is very negative for the dollar because it means QE2 doesn't go away, that we get an even bigger round of quantitative easing following. And that's very bullish for precious metals. It's bearish the dollar. It's going to be bullish for foreign stocks.
Hey, Peter, it's Tim. Let's define the dollar, the crosses we're talking about, because like you, I'm an emerging markets investor. I think that it will be parity against the Brazilian real at one point, which is now about 1.54. I think the ruble, I think the yuan are all moving stronger against the dollar in the long term. But when I look at the yen and I hear the Bank of Japan say that they're in a very severe situation, and I look at the ECB say today that they're talking about reprofiling Greek debt. To me, that's restructuring. That's giving a haircut to bondholders who've invested in euros. I look at the two other major cross economies, and they're a basket case. Okay, well, Japan is first. U.S. GDP in the second quarter will probably be north of 3%, even with a Japan earthquake and a downgrade on industrial production.
Yeah, so I agree. Well, we are way underweight both the euro and the yen. But the problem is, as bad as the situation is in Europe and Japan, it is worse here. Remember, we owe Japan $1 trillion. We're in much worse shape than Japan. They still have big exports. They have high savings. We've got this complete phony economy. The idea is people thought that QE2 was training wheels on a bike, that the Fed was putting training wheels on the economy, and as soon as the economy could go on its own, they would take the training wheels off. Well, QE2 isn't the training wheels. It's the only wheels. And if you take QE2 away, this whole thing implodes. We're a house of cards. That's why it's not going away. And as soon as the market figures that out, that's the situation our economy is in, that it's completely addicted to 0% interest rates and endless quantitative easing, that is a major, major problem for the dollar in our economy.
QE2 ending is dollar positive.
Peter, we got to leave it there.
But it's not going to end. It can't end because we'll be in a worse financial shape than 2008. If QE2 comes to an end, it's not going to be. We're going to default on the debt because we're not going to be able to make the interest payments. All the banks, all these major banks are going to fail again. Their balance sheets can't withstand rising interest rates, and interest rates would rise sharply if you take the Fed out of the picture. There's no way around it.